Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight at the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed right here on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Wednesday afternoon, we have Ryan McCormack, Factor and Core Equity Strategist at Invesco, to discuss Nasdaq-100 weekly performance relative to the S&P 500. We'll also take a look at some jobless claims and year-over-year data just to see how well the markets have recovered. Ryan, it's great to see you again, as always. Let's take a look at your first weekly chart.
Yeah, thanks, Jill, and thanks for having me. A challenging week for stocks. You had QQQ and QQQM down 1.01%. The S&P 500 down 1.3%, and S&P 500 value down 1.85%. So sort of a pause for the bull market this week. And I think you look at some of the areas of pressure. You had interest rates climbing and then retreating, right? It passed 1.75% and then they backed off. I mean, they continued their retreat after Jay Powell, again, continued to note that this business comeback and the comeback of the economy on the whole is very far from complete. But the main story in the markets is just watching these inflation worries. I mean, the 10-year really does seem to be steering the equity ship. And as you look at the QQQ performance chart over the past week, it kind of ebbs and flows with wherever interest rates go.
And Ryan, when we drill down more to sector performance, what's been leading the way?
Yeah, so a QQQ down less than the S&P and down less than the S&P 500 value. That outperformance is really just driven by an avoidance of the worst performers. In this case, is maybe some of the shining stars from a sector side of the equation this year: energy and financials. You look at energy, was dragged lower by falling oil prices. We've seen a bit of a slide there. X today, where we see energy prices rallying after a tanker is blocking the Suez Canal. Financials kind of came under pressure last week after the Fed elected not to extend relief from capital requirement rules around supplementary leverage. So they're going to allow that to expire on March 31st. And you look at financials on the whole, came under some pressure there.
And Ryan, walk us through your last couple of charts here, because when we talk about the market being a discounting mechanism, you can just see how the improvement in the market. Now we're seeing the jobless claim data start to catch up with that. It really is quite the remarkable rebound that we've seen in just basically a year since our March 23rd lows.
It is, yeah. So today is essentially the one-year anniversary of the start of this bull market, and over the course of that time, we've seen a lot. Trillions in stimulus and aid and benefits. We saw a record economic contraction last year in Q2 of over 31%, the largest contraction since records were kept. And then right afterwards, a record expansion of 33.4% in Q3. I think the employment picture is an interesting one to look at, because you look at initial jobless claims just about 1 year ago for the week ended, I think it was March 27th, we had a high of 6.867 million jobless claims, which blew the previous record out of the water. The previous record was 695,000 in October of 1982. Since then, as you look at the jobless claims figure, that number has been in a pretty steady decline. But as you recall, you look back to last year in the middle of that jobless claims spike, in the middle of that economic contraction. I mean, there was a ton of uncertainty in the market, right? I mean, we still haven't gone to offices for the most part. We haven't seen the handcuffs completely taken off the economy. So some of those things linger, but the picture looks a lot rosier than it did 1 year ago. And I think as you look back to kind of the environment that we were in back in March 23rd, 24th of 2020, when this initial equity rally took off, it really does show that equity markets do kind of lead the economy, right? They're consistently looking forward. And lastly, when you look from the COVID lows, so to speak, you can see that QQQ is up nearly 87% over the 1 year. You see the S&P 500 up nearly 78%, and S&P 500 value up over 72%. So, I think to the point that markets generally lead the economy, I think that's fairly consistent with looking at the trend of economic data, but also how quickly the equity markets rebounded from that extreme uncertainty that we saw last year.
All right, Ryan, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.